Dobar dan, dobrodošli. Today's roundtable is live from Croatia. Before getting to the heart of the presentation, I would like to share a few information with you. This is our last roundtable this event season, and we will have a unofficial or official beer for members after this event. We will let you know about exact time, date, and place where we are going to meet. Last but not least, on behalf of CFA Society Slovakia, I would like to thank to our partners, Tatra Banka, ČSOB, Erste Asset Management, EY, KPMG, ProRate, Quantic Financial, Alder Tree, Ellen and Overy, and VUB Banka. Now, a few housekeeping notes. This presentation is recorded. So by staying joined to this meeting, you express your consent. The video will be later shared on CFA Society Slovakia's YouTube channel. And now, without further ado, let me introduce Mr. Roland Demel. Roland is a founding partner with Quantic Financial Solutions. He served universal and central banks as well as insurance companies globally in projects on Basel II, risk management, bank planning and strategy, stress testing, company valuation, as well as bond and share price modeling and asset management strategies. Mr. Demel, now I'm handing to you. So please take it away.
Thank you very much, Martin. I'll share my screen with all of you. And ideally, you should now see a rock underneath a starry sky. Can you see it?
Yes.
Okay, so we can start. One remark before I start, whenever some of you has a question, please click on the lift hand button, because then I can see it and can directly take your question and answer it, okay? Now, today we want to talk about a study that we recently did about creditworthiness of Slovakian firms in a stagflation scenario. And see, I need to put a little window with where I see Martin's on the side so that I still can read what I'm doing. For this study, we employ a 4-step approach. And the steps will later become clear to you once we go through our study. First of all, we have to choose a macroeconomic scenario for Slovakia. Second step is we feed this macroeconomic scenario into our unique tool, which is called Deep Data Analyst. A little bit more to that in 2 slides. The tool actually forecasts all the balance sheet and P&L items of any corporate firm or bank. We use those results to then derive a probability of default for each of the corporate firms using our own rating model. And finally, we aggregate these PDs on the level of Slovakia overall. And we also distinguish the companies in our sample by 15 different industries, and can actually then do analysis of how the creditworthiness of the companies will be affected by the current stagflation scenario. Now, the presentation examines the impact of a stagflation scenario on the creditworthiness, as I already said. What is our definition of stagflation? Stagflation is a macroeconomic environment where prices rise significantly and somewhat unexpectedly, thus suppressing economic activities, leading to low or even zero economic growth. Germany, for example, is currently facing a situation where some economists think that this year will be a year where German economy has a negative growth. Others think that we have a slightly positive growth. Now, situation for Slovakia is better. One remark to the word stagflation, it's actually an artificial word. It comes from stagnation and inflation. So it combines an effect that prices rise and nevertheless GDP growth slows down, even can become negative. We assume the following macroeconomic scenario for Slovakia. Well, 2022 has realized. So the numbers here that we use from the International Monetary Fund's World Economic Outlook should be rather precise descriptions of what happened last year. Inflation 8.1%, GDP growth 2.6%. But for this year, it is expected that inflation even rises a little bit more to 9.7%. But comes then back to more pleasant values of still rather high 5.3% next year. And in 2025, it shall settle down at 2.4%, which is even a bit lower than the historically 3 to 3.5% that Slovakia saw over the last decade or so. In terms of GDP growth, you see that the scenario assumes that this year there will still be a positive growth for Slovakia, but significantly lower than last year, 1.5%. And this is then about to go up again to 2% or 2.4% in 2024, 2025. This is the scenario that we employ, as I said, based on the January values of the World Economic Outlook published by the International Monetary Fund. We use a general equilibrium model, which allows us to even forecast longer into the future. So therefore, the 2024 and 2025 values come from our model which we have actually calibrated to the IMF data 2022-2023. In general, we can use any macroeconomic scenario that one is interested in. We could have used a very positive scenario as well, or a much more negative scenario as well. But this is what we think is the best consensus scenario for the current situation. Now, the next step is we need to translate this scenario into financial statement forecasts of companies. And this is by employing our deep data analyst. You can actually see on the left-hand side of this graph, there are multiple macroeconomic variable entries: GDP growth, unemployment rate, price index, interest rates, oil price, etc. And on the right-hand side, we forecast the balance sheet items on the asset side, the equity positions, the liability positions, and the entire P&L, position by position. And what we have in the middle is our deep data analyst. This is a multidimensional algorithmic system that has been estimated on millions of company data with histories of often more than 10 years. This is validated, this model, year by year. It's in production since 2014. And if you count the equations in the model, then you get to something like 55,000 to 60,000 equations. So it's a rather mighty tool. And once we employ that, we can actually put a macroeconomic forecast scenario into it. Then comes out the forecasted financials for any firm that you have a starting balance sheet for. And then you can actually use that to derive diverse business applications. And here in our study today, we will talk about the probability of default that comes out as a forecast for the years 2022 to 2025. Now, step 3 is the corporate rating model that we employ. We have 6 partners in the company, and 4 of the 6 had a long history in risk management, consulting work for banks and insurance companies all over the world. Before 11 years ago, we founded Quantic. And so we know inside out how to build such a model. Our rating model actually makes use of the financial statements of the firm. And we actually use causally relevant ratios to explain creditworthiness of a corporate firm. For example, EBIT per turnover as a probability measure, because everybody knows that the higher the probability of a company, the better is typically the creditworthiness inter alia. We use also leverage. We use liquidity measures, and we use a business model efficiency measure, which actually says how much do you actually have to put in liabilities into the companies in order to generate euro in terms of turnover. Now, we're weighting these ratios, and that actually leads to our financial score for every company. And this score is then calibrated to a 1-year probability of default. using both external ratings if applicable. But as you will know, external ratings are only applicable typically for the bigger firms. But we have done these analyses so often that we also have access to historical default rates, which we can actually then use to calibrate the model as well. So as soon as we have forecasts from our deep data analyst in terms of balance sheet and P&L data, we can then directly derive forecasted corporate probabilities of default, and can actually do then forward-looking purposes like analysis of an entire portfolio. And the final step in our four-step approach is that we actually turn the PDs into aggregated PDs. Here again, I show to you the flow of calculations. On the left-hand side, we have the last available balance sheet year, which is 2021, because for almost all Slovakian companies, we have balance sheets by then. The 2022 balance sheets are only available for typically the top listed firms, because listing often requires to have the data ready within 3 months after the end of the year. So the first prediction that we do is with the realized macroeconomic figures of 2022, we calculate pro forma balance sheet and P&L data for the companies that we have in our study. And from this on, as a third step, we do then the forecast for this year, for next year, and the year after. That's actually the approach. Now let's come to so far, everything clear? No questions? Okay. Let's then come to the branch structure of our sample of Slovakian companies. We chose 2,270 Slovakian companies because they have published 2021 financial statements and they have more than 5 million euros turnover. The reason why we chose those firms is that for 2022, financials are frequently not yet published, so we would have ended up with a much smaller sample. And since we want to look at the different industry segments, we need a minimum amount of data, as you can imagine. So if we look at the graph, then we see 673 companies are in the trading sector, and that makes up roughly 30% of the entire sample. If you look at machinery and automotive, they are around 230 entries, so that accounts for another 20%, i.e. the top 3 most frequent branches in our sample are trade, machinery, automotive, 50% of all the firms. Now, the next 5 branches, namely services, transport, construction, chemistry, and pharmaceuticals, and consumer staples, make up 30% of the samples. As you can see here, we have 193 service companies in the sample, 162 transport, 112 construction, 110 chemistry, pharmaceuticals, and 104 consumer staples. And the last 1, 2, 3, 4, 5, 6, 7 sectors make up the missing 20%. This is energy with 93 companies, media with 87, durable consumer goods with 69, financial services 61, same number optics and electronics, basic material 52, and agriculture sector with 37 companies. So this is the sample. Now what we've done is the following. We have for the entire sample, for each firm, we forecasted the complete balance sheet and income statements 2022 to 2025 based on the macroeconomic scenario that I've shown you in the beginning. Based on these forecasts, we then apply our rating model and calculate a probability of default for each of the 4 years and each of the companies. The final step is then to compute aggregated PDs across industry sectors using arithmetic averages, and we index that to 100% in 2021. And the outcome is then the graph that you see here on the left-hand side, in the upper left-hand side of this slide. And you see a steady growth in aggregated probability of defaults across the entire sample of 2,270 firms. And it means that even from 2023 to 2024 and from 2024 to 2025, we see an increase of aggregated PDs, although the macroeconomic scenario tends to revert back to more normal times. We'll see later on why this is the case. Another graph that we've shown here shows significant differences by industries. Here we look, the graph on the lower left side of the slide shows the growth over 4 years of the average probability of default of every industry segment. And we see, for example, that agriculture with 4% and media with 70%, with 7% show almost no growth because over a period of 4 years, this is for media 1.5% growth per year, which is almost nothing. And for agriculture, it's less than 1%. So you can actually see these are the two industries that pretty much remain constant in terms of aggregated probability of default and therefore in terms of creditworthiness, i.e. they look as the sectors that stay most stable. Just on the opposite is construction, energy, and optics and electronics. Optics and electronic growth, the average PD here grows by 59%. So if the average level was 1% probability of default in 2021, it would be 1.59% in 2025, which is very significant. Now,
we have one question, Roland.
Yes.
Yeah, Pavel, please go ahead and ask a question.
Thank you. Hi, so this is Pavel Kiralvarga speaking. I'm just in the same office with Pavel Truchan, so that's why you see Pavel Truchan speaking.
Hi, Pavel.
Hi. Just one quick question related basically to both charts, but I noticed when you explained the first one, top left, if I understood correctly, that's based on number of firms, so it does not relate to the size of the firm at all, right? So even if in the previous slide you show number of firms in respective industries, and I think trade was the highest. So there could be many but very small firms, and let's say the probability of default is then very much influenced by small firms which are just, let's say, in a wrong industry. It does not have to be trade. I just mentioned as an example.
Mm-hmm. Yeah, that's true. The figures that you see here are not weighted with exposures or size metrics, for example. Yeah, it's simply that we calculate the probability of default for every company and then add up all the probabilities of default and divide by the number of observations, namely 2,270. This is how we get to the indexed PD on the upper left.
Okay, but then it does not tell us, if I understood correctly, somehow a probability default of the Slovak economy as such, right? Because it is not weighted, right? So it could be just small companies obviously have a higher probability of default. I think we can generalize that.
Typically, this is true. Yes, this is so-called number weighted. It's not exposure weighted or turnover weighted or total asset weighted. But you could, of course, do that as well. Yeah. And then, of course, the bigger companies would gain higher weight. Yeah, yes. If you use such measures.
Thank you.
Mm-hmm. You're welcome. So let's actually switch to some pairwise comparison. I've chosen media and agriculture because they look so stable over time. So the fact that branches react quite differently can also be displayed comparing media with agriculture. Here you can see in 2021, both started very low aggregated PD levels of around 93, 94 base points. While the average PD of media is the red bars, grows typically relatively 1 percentage point, so that they grow from 93 base point to 100 base point in 2025. Agriculture almost stays constant, right? So starting out at 94 to 97 base points. Hence, stagflation has a stronger and longer lasting negative effect on firms active in media compared to firms active in agriculture. But the level of PDs is for both industries still quite low, I'd say. And therefore, on average, you would say this means that they have high creditworthiness. Now, if we compare optics and electronics, which was the industry that had the highest growth rate over the 4 years from 21 to 25. If we compare this to automotive, then you see also an interesting picture. Automotive starts already on a high average PD level of 1.41% and grows then relatively by a bit more than 20% to 1.72%. But optics and electronics take so much more risk that they even overtake automotive in 2025, where the average PD of optics and electronics is for the very first time in this period higher than for automotive. Hence, optics and electronics is much more hit by the current stagflation scenario than automotive. They made up their entire, their much lower starting level and end up at a slightly higher PD level. Now, average credit risk levels of industries and winners and losers is what we look at the next slide. Looking at average PDs 2021 and 2025, the 2021 values are the blue bars, the 2025 values are the red bars that you can see in the upper in the graph on the upper left of the slide. And also here we can actually spot significant differences. The 3 least risky sectors in 2022 were basic material, media, and agriculture. Media and agriculture we already see on the previous slides. And you can also see that, okay, basic material has a slight increase in PD, and therefore loses its first rank in 2025 to become only number 3 behind media and agriculture, but still is in the top 3, whereas media and agriculture almost show no increase in probability, average probability of default in 2025. And therefore, if we did not sort this graph by the blue bars, i.e. by the 2021 average PDs, but by the 2025 average PDs, we still would have seen media and agriculture in the front, but basic material only at number 3. In contrast, if you look at construction, which is actually the industry where I put the one circle around, and if you look at optics and electronics, which we have already discussed, this is the industry with the second circle around, then these two show significant increases in PD. And had we sorted by 2025 PDs, you would see that construction would easily lose their 4th place, so to speak, and would fall behind trade, behind chemistry and pharmacy, and behind manufacturing, ending up at number 8 or so, right? So this this shows that we have a lot of rank changes in the industries in the 4 years that we are considering here. Energy and financial services, for example, and also, as well as services, are the 3 industries that were highest in the 2021 values, and they stay highest in 2025. So generically, in our sample, they show the highest average PDs. Now, the next step was we defined winners as all those Slovakian firms that have lower PDs in 2025 than in 2021. And here we see a quite interesting picture on the bottom left of this graph. Optics and electronics is the only industry with significantly fewer winners than losers. So 39% of optics and electronics have lower PDs or equal PDs 2025 compared to 2021, but 61% of the companies in there actually have increased PDs. But then come a couple of industries like agriculture, basic material, financial services, energy, where you could say the same amount of winners or losers. And in case of agriculture, we have seen that those companies, the 46% winners and the 55% losers, balance themselves completely out in terms of PDs because there's almost no increase in aggregated PDs. However, there are a couple of branches that show more than 2/3 of winners, which is transport, machinery, trade, automotive, and media, which was the top branch in the analysis before, right? Because they have significantly more winners than losers. And this actually shows that the average PD can be misleading because media, trade, automotive, they all grew in terms of average PD 25 compared to average PD 21. But they have more winners than losers, i.e. the losers must have deteriorated so strongly in creditworthiness that they drive up the average PD that we have seen before by branches. So this shows that despite growing average PDs, an industry can produce enough firms with lower PDs, thus improving creditworthiness, which means it really counts to look at the single cases, at the single companies. So clever firm selection can therefore produce much lower credit portfolio risk despite aggregate risks. This is the outcome of this slide. Now, despite the trend of increasing credit risk, our analysis reveals lots of diversity at the single firm level, as the last slide has already indicated. So let's have a closer look into optics and electronics, our industry, where the aggregate PD grows strongest from 21 to 25. And this is the slide that you can see on the top left. The blue bars are the PDs 21. And the red bars are the PDs 25. And here we've sorted our optics and electronics firms into risk classes, so to speak. And the average PD in each risk class is what you see on the horizontal axis, on the x-axis, right? And we see that in 25 firms were in the best risk class compared to 23 in the year 2021. Which is the circle actually on the left-hand side, i.e. we have two more top firms in 2025 within the sector of optics and electronics, despite the difficult macroeconomic environment, right? The next 8 risk classes, so to speak, show then fewer firms cumulatively in 2025 compared to 2021. So they add to the average risk of this sector. And finally, the two circles that you see here on the right-hand side and at the extreme right, those are 1, 2, 3, 4, 5 firms that have enormously increased in terms of risk. So they were really hit hard by our macroeconomic scenario. And those are the ones that drive the average PD of optics and electronics up by the 59% we've seen in previous slides. We've also done a slide that actually shows the net migration between risk classes in 21 and 25. This is also interesting. The best risk class, as we see, contains 2 more firms in 25, which is the blue bar on the left-hand side. Then the second and third best risk classes have lost 6 firms, migrating towards worse risk class. And finally, 6 firms are shifted into risk classes with more than 5% PD. These are the 4 bars here on the right-hand side of this distribution. And both graphs show that the PD distribution 2025 gets wider and is much more shifted towards higher PDs. Nevertheless, as we saw, you can also find winners. And therefore, careful picking and careful analysis of the single firms is really worthwhile. We already come to the summary before we can actually start our discussions. It's 12:35, so I think I'm in time. The study shows that the macroeconomic environment has a significant impact on Slovakian corporate credit risk overall. Aggregate PD results for branches, etc., can sometimes disguise reality, implying too lumpy view on the diverse behavior of the firms. What really counts in practice is to know any single customer in their own portfolio and its sensitivity to macroeconomic conditions. This, I hope, got clear out of the study. These results show where our financial position forecasting solution, DDA, has its sweet spots. Namely, it allows to filter out high and low credit risk corporate clients. It therefore can contribute to a significantly improved risk-return relationship of any credit, bond, or loan portfolio. And moreover, we can show similar results for any other interesting firm metrics like turnover, P&L after tax, cash flows, etc., you name it. But in this study, we're focused on the probability of default. And I hope that this was of some interest for you. I've come to the end of my talk. So do you have any questions or comments?
Yeah, and we have a question. Fero, please go ahead.
Hello, Mr. Daniel. Thank you very much for a very interesting presentation. Actually, I would have two questions. Firstly, quite a lot of Slovakian companies are subsidiaries of foreign companies.
Mm-hmm.
Does your model take into account also some kind of parental support or some scenarios from outside of Slovakia or not?
The model as it stands right now is a model that only looks at the sphere of the company itself. The support of third parties, because third parties could also be governments, not only the mother company, but support of third parties can be included. But then we need to typically define a matrix where we say how important is the support from a strategic viewpoint of the mother, and how important is the support given the linkages between mother and subsidiary in terms of who is providing which services and products. And this is typically what banks also need to do. So whenever we see, or when we work for a bank, we put that support level manually on top of our model. And then we can, of course, calculate a PD taking the support into account. Because for example, if the companies, the mother companies sit in Czech Republic, in Germany, in Italy, wherever, we can of course do the same analysis for the mothers, choosing coherent macroeconomic scenarios for the countries where the mothers actually are domiciled.
Mm-hmm.
But the link, of course, i.e. the support logic, that is which we need to overlay in our model. And since every bank does that on their own, we only do that if we work in a banking context for the banking client itself. Did you get what I...
Yes,
Yeah.
I think yes. I think yes. Perfect. Thank you.
Yeah.
And my second question: if we assume that the PDs are some kind of risk metric,
Mm-hmm.
does it have also value for a pricing purposes? Here, I mean that if there is some kind of linkage, that if the company has higher PD, then also some kind of profitability metrics like ROE should be also higher in the longer term or not?
We could, of course, use these results together with a portfolio model, which, surprise, we also have one, in order to derive measures about expected loss and unexpected loss, which then could flow into, for example, a RAROC or RAROC calculus, which you could then actually use to price loans.
Mm-hmm. Okay.
Because this is also what we've done very often in the past. Thank you.
Mm-hmm. Thank you very much.
Paul,
Any further
please go ahead. Yeah.
Hi, Roland. This is Pavel again, but the other one.
Mm-hmm. Yeah. Hi.
I would follow up on the question which was raised by Pavel Kira-Varga. By chance, do you know how the aggregated PDs for Slovakia, or the evolution of it, would look like if you weighted by, I don't know, balance sheet or some other value, comparing to number of companies weighted approach?
Not out of my head, but I could actually go back to my sample and do that calculation.
Okay, thank you.
If you would like to do like me to do that, I can actually provide the results. Yeah. Would you like to take total assets or turnover? Which is the metric that you would like to weigh the results by?
Let's say turnover.
Turnover. Okay, we can do that. Yep.
Thanks a lot for that. And the second question, do you have by chance a comparison with other countries, neighboring countries?
We have done a study for Austria and Germany. That was, let me see, I think in December. So with a bit of an outdated macroeconomic scenario, we are about to reproduce that over the next weeks, and then we can compare. The aggregate results then were not so far away from the aggregate results for Slovakia, but both countries, Austria and Germany, have other winner industries and other loser industries, if I may be so blunt. So there you see definitely the differences. Yeah.
Okay, thank you.
You're welcome. Any further questions?
Yeah, I would have a question.
Yes, there is one more.
Can you hear me?
Loiso, please go ahead.
Yeah, I have the question related to the basically you are using the statutory data. It means financial statements which are somehow subject to the local rules and regulation. Many times the problem is, and probably you have facing it, that the statutory data based on financial statements are not linked to the economic reality. At least probably you have done some pre-processing. So it means that did you identify a group of companies which are not feasible to be forecasted, let's say probability of default, by the statutory financial statements data? If you've done that, the question is, what was the reason why they were not included in the sample for forecasting?
Yes. What I have not mentioned is where our data comes from. Our data, when we talk about modeling banks, comes from Fitch, and when we talk about corporate firms, then the two major sources are Bureau van Dijk, which is a Moody's company, and a large credit insurer. And the good thing about, for example, Moody's Bureau van Dijk is that they have actually come up with a balance sheet layout for corporate firms where it doesn't make a difference whether the firm is based in Slovakia or in France or in Poland or in Portugal, because the way they define all the asset side entries and liability side entries and the equity positions and the P&L positions is invariant of the country. So they have, so to speak, solved the problem already, that in different jurisdictions you have different statutory rules how to count the positions on the asset side, on the liability side, and so on. In our validation, i.e., what we do is every year, once the year is done and we have the balance sheet data from the year, we take the data at the beginning of the year, do the forecasting of all the positions, all the financial positions, based on the macroeconomic scenario as it stood at the beginning of the year, and then compare the ex post values for each of the balance sheet and P&L items to the forecasted items. And this gives us a good picture of the validity of positions. And the good thing about our rating model is that it only rests on statements, on financial positions, which we can forecast with a high degree of validity. And therefore, we don't have that problem. But there are, of course, P&L and balance sheet positions like hidden reserves under the German local GAAP rule, for example. We did that analysis a couple of years ago. And those companies who lay their accounting based on German local GAAPs, the hidden reserve position there was almost unexplainable by the macroeconomy. Why? Well, because you had a lot of leeway as a company to play around with different triggers to influence that position. And such a position then would ideally not go into our rating model because it is too manipulable, it can be too strongly manipulated. Manipulate is a bad word because it's so negative. It can be too easily designed by the bookkeeping department of any company.
And
Did
maybe
this
the
explain?
second, yeah, thank you. Maybe the second question.
Mhm.
Now we are facing tremendous changes in interest rates and tremendous changes in the banking business models. In
Yeah.
Slovakia, we have the banking model that is almost controlled by Austrian and Italian banks.
Mhm.
What would be the influence in general of the current market rate environment for Slovak banks, if probably those are one of the top picks in the sample?
Well, I can't explain, or I can't answer this question in general because it pretty much depends on the structure of the credit portfolios of the different banks. So if a bank has, for example, a strong chunk of their loans in optics and electronics, then our analysis would suggest that the bank might need to calculate with strongly rising provisions. On the other side, if they have done a good job just selecting the winners that we have seen on one of our last graphs, then it can well be that the portfolio, even though the times are rough right now, the portfolio stays very stable in terms of credit risk. So it really depends on the structure of every bank's portfolio.
Thank you very much for your answer.
Slight
Okay,
comment
I have
from
one
my
more
side.
question.
I mean, yeah, one slide comment from my side.
Yeah, please go ahead.
Yeah, if you allow, some 6 years ago, we've built models for a huge banking association in Europe with 800 member banks. And we saw there that there's a very positive relationship to what's the English word for that? In German, we say active-passive marge, which is the margin between the interest rates you charge from your asset clients on the asset side, so bondholders and credit takers, minus the interest rate you pay to your depositors. And the stability of the banking system increased actually in the situation like this, where the interest rate rise, because the banks are able then to increase this margin again. Although it also means that they have to increase their reserves for rising credit risks, but the first effect more than outweighs in general the second effect. But it has to be taken into account. You have to look at the single banks in a single way, which we have not done here yet.
Okay, my question is that if there is any like a ESG score that would add or lower the PD score of any company.
We have not yet built in ESG scores because the problem is that if you look at information about ESG, for example, we have a global equity ETF product together with Barclays where we use ESG data, which comes from Sustainalytics, but this data is only available for the top 10,000 listed companies in the world. So if you go down into the mid caps and even more into SMEs, you won't find that data in order to calculate such an ESG score. But we'll see. I mean, maybe over the next couple of years, a standard gets implemented of how to measure the relevant variables and how the firms actually themselves can actually measure those data and can get them audited in such a way that we can then employ an own ESG score and to measure that down to smaller companies.
Okay. Understood.
Currently, it's only available for the as I said, for the listed companies, because stock exchanges require that. But for the mid-cap sector and the SME sector, we find practically no country where this data would be available.
Okay. Is there any other question? This is time to ask. Okay, if there is no further questions, then thank you very much for the presentation, Roland. It's been a pleasure to hear your thoughts on stagflation and your model. And we will see you next time. And the video will be on YouTube. If someone finds some parts or the whole video interesting and wants to go back and listen to it again, it will be available on our channel, CFA Society Slovakia YouTube channel. Thank you very much. And if you don't eat, then bon appetit. Thank you very much. Bye-bye.
Thank you. My pleasure. Bye.
Thank you. Bye. You bye.